So the next person I want to bring up is actually I just met them not too long ago, and we decided to collaborate together because it was like a kind of like a match made in heaven when we started doing business together, right? He's a managing director of Core Vision Accounting and Advisory Group, a firm dedicated to helping business owners align their finances, strategy, and operations for sustainable growth. With over a decade of experience in tax, finance, and strategic advisory, Larry blends deep technical expertise with a practical, real world approach. He's also the creator of the Precision Growth Model, a proprietary framework that transforms financial data into actionable business intelligence. And today he brings his passion for empowering entrepreneurs and his commitment to innovation to every stage and client interaction. Everybody, welcome Larry D. West III.
Awesome. Thank you. Thank
No
you.
problem.
Certainly appreciate it. Thank y'all. So it's always a pleasure to have a chance to talk accounting nerd stuff with people who are willing to listen, because oftentimes we're just locked behind a computer, behind a desk, and so we don't get to interact with folks that much. And I'll try to make today's presentation not so accounting heavy and boring. So there are really three things that I want to present to you today, and want to give you some insight about. First, I'll just kind of give you a little bit of an overview of our firm. As Oscar mentioned, Core Vision Accounting and Advisory Group, we're really designed to be a proactive accounting and advisory firm. And what that essentially means is around, perfect. So around this time, what typically happens is you sit and you talk to your accountant and they tell you everything you should have, would have, and could have done last year. And you're like, hey, that would have been great to know 6 months ago, but I can't do anything about it now. We try to take that concept and flip it on its head, where we want to talk to you today about things that are happening this year so that we can plan and put a tax plan and tax strategy together so that there are no surprises at the end of the year. But not only what's happening in 25, but also what's going to happen in 26, 27, and also things that will go into the future. So we want to be proactive in terms of our approach. And so a lot of the things that you heard here today fit really great into some of the items that we talk about. Again, I just want to give you a couple of tips from an accounting perspective and a tax perspective that I think could help you with respect to finance, wealth building, and things like that. The first of which really revolves around how do you pick the right accountant? Again, oftentimes we kind of go to either folks that our parents have dealt with or folks that are referred to us. But when you're getting into the space of entrepreneurship, what you really want to look for is a professional that knows your specific industry that you're in. Oftentimes we have a lot of generalists, and you think about it when you think of healthcare, I think is a great example. You'll go to your primary physician for all things, standard checkup and different things like that. But if you have a traumatic brain injury, or if you have a back injury, you're not going to your general practitioner. You're going to your spinal doc, or you're going to your neurosurgeon, because they specialize in that particular thing. And you want to take the same approach when you're thinking about accounting and your finance, because accountants tend to be generalists. You want someone who zeroes in and knows your industry. So if you're playing in the real estate space, you want an accountant who knows real estate front and back, because oftentimes they're able to identify things that the generalists may miss, right? So that's the first thing you want to do when you're thinking about how to look for and pick your accountant, is someone who specializes in your space specifically. Secondly, and this is just a thing that happens in our industry quite often, you want someone who's responsive. I was just having a conversation not that long ago where we were talking about our industry. We have a lot of demand and not a lot of supply when it comes to professionals in this space. Kids just don't want to go into accounting anymore. And so a lot of firms are overwhelmed with so much demand. But for you, again, this is the important part about working with specialists, is that when you have a question, you often need that question answered right away. You can't afford to wait 2, 3, 4 weeks down the line to get those responses. And so someone who's a specialist in your space and someone who can respond to you timely typically will make, at least initially, for a good relationship when you're thinking about an accountant, okay? You don't want to roll out of bed and go to H&R Block down the street. No disrespect to H&R Block if you were in here, but you don't want to go to that place down the street, because again, oftentimes, there you go. He said it, not me, but I endorse that message. But again, you want someone who specializes in your space specifically. Okay, so that's number one. How do you look for how you pick an accountant? Number two, and this is going to be specifically around jumping into the real estate space. Oftentimes we talk about wealth building, we talk about investing. One of the ideal spaces to build tax efficient wealth is in the real estate space. Among all the other things that we just heard, those are some phenomenal spaces as well. But when you think about hard assets and growth, almost no industry or asset class gives you the tax benefit that real estate gives you. And it's really because of this one sneaky thing called depreciation. Okay? The simple way to think about depreciation is it's a gift from the IRS. It allows you to reduce your taxable income from the rental money that you're receiving from your tenants. Perfect example, let's just say we go buy a $500,000 single family home. We know we have to put our down payment down and all those other things, so we come out a little bit of cash up front, but we typically are going to do a loan, right? 90%, 80%, 70% kind of a loan. The point is, we didn't spend $500,000 of hard cash. We put a little bit of a down payment. We took a note for the rest. The depreciation deduction allows you to take a deduction every single year equal to the purchase price of the property divided by 27 and a half. $500,000 property means that's an $18-ish thousand deduction every year. That means you get to take your first $18,000 of rental income completely tax-free. There's no loophole, there's nothing special you have to do. It's essentially a gift that you get for purchasing that asset. So if you can buy an asset for $500,000, doesn't cost you that out of pocket, and now your first $18,000 of that income is tax-free, that's earning more money but not paying more tax. That's a great road to building wealth. Not to mention, you also have a $500,000 asset to do something with down the line. So and when you look at a lot of our elected officials, some of the most successful people, at least financially successful people here in the United States, almost all of them will have some level of real estate in their portfolio, and it's for this reason. They earn money, but not necessarily pay more tax. Not only that, but given the environment we're in now, with depreciation, there's also this thing called bonus depreciation or accelerated depreciation, as they call it. And just a broad example there, that same $18,000 deduction that we just talked about, if you do what's called a cost segregation study, that 18 could easily be $50,000, $60,000, $70,000 right away in year one. So again, you have a hard asset that's valuable, that grows and appreciates over time, especially in a place like Frisco. Then you also have a depreciation deduction that allows you to earn money but not pay tax. That's what makes real estate a really good tool for wealth building. And then the last part about that is we call this concept, don't sell grandma's house. We always want you to hold on to the asset essentially. And what that means is if you hold on to the asset long enough and it appreciates over time, if you structure it appropriately, if and when you pass on to the next stage of life, that asset can now pass to your family in a very tax efficient way. You buy a $500,000 asset, let's say you hold it for 30 or 40 years, a place like Frisco, that could be worth $1.5 million after 30 years or so, right? Just because appreciation just goes crazy. All of a sudden, that $1.5 million property passes to your family potentially completely tax-free. They now have a $1.5 million asset that they can do either reset their depreciation clock at 1.5 million. They could sell it at 1.5 and pay no taxes on the complete 1.5 because we have what's called a step up in basis, or they can continue to rent it out and earn tax-free cash flow down the line. Gives them a huge step up and a huge jump forward in terms of wealth building and wealth creation. And again, we just call the concept don't sell grandma's house. So it means if you're going to buy the asset, if you do sell it, make sure you go buy more property. But if you don't, hold on to it and then structure the estate plan appropriately in such a way that it can now pass to the next generation tax-free. So, quick recap on those 2 points. Pick your accountant, someone who knows and specializes in the space that you're operating in. Number 2, real estate is a great asset class to build wealth, again, amongst some of the other items that we just heard. And then number 3, if you forget all that, just call Larry. That's all you have to remember. So that's all I have on my time. Thank y'all. Sure. Do we have time?
Yeah, we got
for
Q&A.
questions.
Yeah, Q&A.
Yeah.
Can we do a few Q&A? Anybody have any questions for Larry real quick?
If I buy a property subject to,
Mhm.
because the loan is still on the owner, the previous owner, do I have the tax benefit or he doesn't?
Great question. So the question there was if she buys a property subject to, and subject to essentially means you're purchasing a property subject to the existing mortgage. It stays with the original person who took the mortgage, but now you get to take over the payments. And presumably, if done right, you typically will have a lower interest rate than if you went to market. They own the note, but now you control the property. Do you still get to take the depreciation deduction? According to the way the IRS rules are written, yes, you do. because you take on the economic, I forget the technical way that they frame it, but think about it this way. You take on the economic risk of that property. You're responsible for those payments. If you don't pay, it reverts back to the original owner, which now means you get to take that depreciation deduction. There are a couple of other things you'll want to do in terms of how you structure that deal just to align your paperwork. But the short answer is yes, you absolutely can start your depreciation clock based on the agreed upon purchase price.
But also, would you also have to make sure you have title to that property as well?
Absolutely. So that's a part of the extra part that you want to do with respect to paperwork. You want to make sure that you are on title to demonstrate ownership and also the economic risk that you're taking on.
Got one for you. Okay, let's say I had money set aside, cash money set aside
Mm-hmm.
from previous business, stuff like that. Wasn't in the bank, wasn't showing up nowhere, nothing else.
Mhm.
I took, say, $25,000 and I bought some property with it.
Mm-hmm.
Okay, now I sold that property. So how do I take that 25,000 back out of that money? Say I sold it for 40,000. How do I take that 25,000 out and put it back into cash reserve again?
Gotcha. Without paying taxes on it, because presumably you pay taxes on it in the past. So what you're referring to is what's called basis. And again, this is one of the reasons why you want to work with the accountants who understand your specific space. Because if you paid $25,000 for it, we've now established your basis, your initial equity, if you will. There may be some nuanced calculations if you depreciate it, but let's assume you didn't. You just bought it for 25 and sold it for 40. Now when your tax return is done, we reduce your capital gain by your basis, by the 25 you put in. So now you only pay taxes on the 15, on the 40, the extra amount that you earned. The good thing about it too is depending on how long you hold the asset, you pay capital gains tax. Hopefully it's long term, so you've held it for at least a year and a day. And if that's the case, your capital gains tax rate is either 0, 15, or 20%. Regardless of which three of those numbers it falls into, it's going to be lower than your individual tax bracket. So there are ways uniquely to structure your entire world where, depending on where your cash reserves are coming from, if you have a sale like that, you could potentially pay no tax on it. You could fall into the 0% capital gains tax bracket, or perhaps the 15 or the 20% if income is higher.
I can just take that 25 out though and just put it back in the stash again.
That's right. That's right. Yep. Or take the whole 40 and go bigger on the next purchase.
Yeah.
What other questions?
How did you become a accountant?
That's a very good question. This was not my first career path, if you will. So when I first graduated, I taught English at the college level. I taught intro level English, English 101. It was a 7:05 a.m. class for freshmen. Nobody showed up. And nobody cared about it either. So I quickly realized that I didn't want to continue down that path. I went back to get my MBA in finance and accounting, and I was going to Robert W. Baird and going investment banking out in New York. Well, life didn't have it in the cards for me to go to New York, so I ended up in Abilene, Texas. My wife at the time wanted to go to Abilene Christian to do her master's degree, so I had to figure out something else to do with this finance degree. I fell into the accounting space, went and got my EA, and also went and got some additional accounting training, and I've been building from that space ever since. So, started teaching English, and now finance and accounting is the space I play in.
And how did you become specialized in the real estate space?
Yeah, so the firm that I worked at, I was helping build out their advisory department. This was back in 2017. Almost every client had real estate a part of their portfolio, so I had no choice but to learn it because we were going into the advisory and consulting model. So that's where I really just kind of doubled down. And then I started to realize too, all of the wealthier clients, they all had real estate in that portfolio. So again, just one part is I had no choice but to learn it. The other part is it's actually pretty interesting the way you structure deals, put it together, and what it could do from a wealth building perspective. And so when I launched my firm in 2020, that was definitely one of the specialties that we continue to move forward with.
Are you guys a franchise or just your own firm?
Yeah, just my own firm. Yeah, yeah.
So I got a quick question for you, Larry.
Sure.
So you spoke about single family, but what other types of assets in real estate do you specialize in aside from single family?
Absolutely. So just about everything from single family on into large commercial multifamily. So you think about 2 units, 4 units, 6 unit, 8 units, 16 units, on into the multi 200 plus units that you see that are popping up all around Collin, Denton, and Tarrant County around here. Also commercial spaces, buildings like this or the strip centers that you see, we specialize in those. And of course, those that do private equity funds and syndications, where they raise capital to go buy those buildings, we have a specialty in that area as well.
So all sorts of real
Also,
estate.
yep, from the single landlord to the large PE firm, we've got it covered.
I was gonna say, do you also have somebody specialized in real estate notes?
Notes, what do you mean? And in terms of debt service?
No, in terms like you, let's just say, she had an example, she took a property subject to the multi 60 more apartments, right? Instead of turning it into a rental, I owner finance it and turn it into a wrap to note.
Oh, gotcha, wraps, yes. Absolutely, yep. So we have specialty in that space as well. We've got 2 associates that are really good in that area. Arpit being one that you've worked with before in that area, yep.
So for the multifamily space, right? Because you and I, we connected and we did multifamily together, right? So for someone who's new and they're looking at maybe investing into a deal or maybe even purchasing one of their deals, right? For the first time,
Yes.
what would you say would be like an advice for them tax-wise that they may not foresee coming into something like this new?
Yeah, I think there are really 2, maybe 3 that come to mind. First is depreciation, just kind of what I was talking about before. Typically, if you're raising capital or if you're investing in one of these deals, that's going to be the biggest tax benefit. So make sure you understand the depreciation that goes with the property that you are acquiring. So that's 1. 2 really revolves around compliance, because some of these deals, especially if you're raising capital from individuals you haven't met before, there's not just one of those things where you say, hey, I'm doing this deal, can you give me money to go buy it? There's also legal compliance that happens. There are registrations that need to happen. They're considered what we call unregistered securities. So you want to have your legal team, specifically an SEC attorney who's available for you, and then you want to have your accounting team, specifically someone on the CPA and or accounting side that understands that space as well. And you want those 2 people to talk. You never want them to not talk to one another, because legal typically will frame things in a way that keeps you out of jail and out of an orange suit. And accounting will frame things in such a way that keeps you away from an IRS letter coming your way. And you want those 2 working together at all times. So those are really going to be the benefits. And I say the third thing is understanding the difference between being the sponsor, or what some people would call the GP, and being the investor, or what some people will call the LP. There's a huge distinction there, so you want to make sure you're knowledgeable on what the difference is around those 2 things.
Okay, one last question.
Sure thing.
So you mentioned, having the 2 teams talk together, legal and accounting, right?
Yes. Yep.
And very important to talk to each other. So legal, obviously you don't want to be in the orange suit, right?
Yep.
And then the accounting, you don't want the letter from the IRS.
Yep.
Now, with your experience, I'm sure you might have met a few people who maybe got that letter from the IRS and they're like, hey, Larry, I need help,
Yes.
right? Are you guys still able to help people who maybe get a letter from the IRS?
Yep. And I'll tell you, the best thing to do if you get the letter is to not let it sit. Definitely talk to your accountant right away, because oftentimes it's a lot scarier than what it actually, it looks a lot scarier than what it actually is. But yes, we're able to represent clients in front of the IRS across all 50 states. And so some of these cases are a simple response to the IRS. That's all that's needed. If it does escalate and it turns into an audit, we can represent there as well. Where we stop is essentially when you get to tax court. We then would turn it over to a tax attorney, but anything from a letter response or a simple audit, we can take care of it for you.
Any last questions?
His contact information.
Gotcha. I will make sure, I thought I had some pamphlets, but I'll make sure I have it available for you. If you forget anything else, just go to corevisionaccounting.com, and then you'll find all of our information there. Thank you.
Appreciate it. All right.